everybody in America loses because of what India's doing. The consumers and businesses and everything lose, and workers lose because India's high tariffs cost us jobs and factories and income and higher wages. And then the taxpayers lose because we got to fund Modi's war.
That's the White House senior counselor Peter Navarro calling Russia's war on Ukraine Modi's war, as the Indian Prime Minister refuses to back down on Russian oil despite crushing tariffs. We'll have more on that as Mumbai markets come back online in 45 minutes. Live from Sydney, I'm Paul Allen, and this is Inside. Well, technology stocks in Asia and US futures drop after Nvidia's sales outlook missed expectations. Meituan's profit warning also hurting sentiment. Fears of a bubble are rife, not just in AI, but also in Chinese equities. And we discuss all of that with our guests, Wang from Constellation Research and Fullerton Fund Management's Robert St.Claire. And Indian markets, as I mentioned, coming back from a holiday, they're set to react to the 50% tariff rate that took effect on Wednesday as India-US ties continue to hit new lows. And we'll get your perspectives from investors outside and inside India on how they're looking at Indian markets as sentiment weakens. All right, let's talk about tech because it is moving today following that Nvidia result. I mean, look, Nvidia earnings beat estimates, $46.74 billion in revenue, forecasting third quarter sales of $54 billion, projecting trillions in AI infrastructure, but it still wasn't enough. Nvidia slumping after hours, and it's had a bit of a ripple effect around markets. We're seeing NASDAQ futures softer by 1/3%, the Hang Seng Tech Index weaker as well, and there's, of course, a China-specific story in all of this also. Meituan shares dropping now almost 11%. This is after a second quarter result miss, and that's having something of a contagion effect. Alibaba, JD.com also lower today. All right, let's take a look at Nvidia, the world's most valuable company, of course, signaling that growth is slowing after a two-year boom in AI spending. It's expecting sales, as I mentioned, of roughly $54 billion for the current quarter, and that is well below the loftiest estimates. The company, however, excluded as much as $5 billion of possible China data center sales from its projection amid geopolitical tensions. Now, Nvidia's products, of course, are at the center of a tech rivalry between Washington and Beijing. The Trump administration earlier asked for a 15% commission in exchange for allowing Nvidia and rival AMD to offer their AI chips in China again. But CFO Colette Kress told Bloomberg that the unconventional plan hasn't progressed beyond the early stages, and she says if the plan is not codified, Nvidia should be able to proceed without paying the commission. Well, let's talk a little bit more on Nvidia. We're joined now by Wang, founder of Constellation Research, a US-based technology research and advisory firm. Ray, just want to start with your key takeaways from that result. I mean, plenty of things to be pleased about, but apparently for the market, a lot of things to worry about as well. Any surprises in there for you?
There's not a lot of surprises, but I think the important piece is this is 9 quarters in a row that they beat, and Blackwell sales were up 17%, and that's about $27 billion in sales. And they're also doing a $60 billion stock buyback. So overall, it was a really good quarter. The question is what's out into the future, and that's what investors were looking for, hence the little dip at the moment. But I think one of the important things is that you're seeing this is a $1.61 trillion market by 2031 for AI. That's what our estimates show. And we're just at the beginning. So whether Nvidia has a great forecast for this quarter, 3 quarters out, there's still a ton of spending. Mag 7, 6 out of the Mag 7 are basically spending $80 to $100 billion on data center buildouts, and that seems to be continuing for at least the next 6 to 8 quarters.
Yeah, look, in terms of the growth rate that we've seen in Nvidia, the investment story as well, was it realistic to think that that was going to continue and potentially accelerate forever?
There's a point where it does slow down, but I think part of it has to do with the China numbers, as you were pointing out. There's about $32 billion in chip sales to China that they're losing out by having these tariffs in place. And so as they switch to single die versions of all their chips to be able to sell into China, you're going to see anywhere from 4 to 5 billion, 6 billion, depending where the tariffs come to play. There is still a lot of demand for Nvidia chips, especially as you see what's being passed through Dubai and passed through Singapore. There is a big demand in China still, despite what the government warnings are.
Yeah, a big demand, sure, but how much faith can we have around those forecasts for Chinese demand for Nvidia chips? Considering the narrative around U.S. restrictions keeps changing, and Chinese appetite for Nvidia H20 chips is kind of being leaned on.
Paul, actually, you're right about today, but I'm looking at 2 quarters out, 4 quarters out, when the trade deal and the tariffs actually resolve, we'll probably see the upside on the Nvidia chips, and we'll be coming back and saying we're missing $30 to $40 billion on the chip side. But that's actually not where the near-term demand is. It's going to come from sovereign AI. We're seeing a lot of countries aggregate their capabilities, build data centers, and build to actually serve in their language models. And a great example is what was happening in Saudi Arabia. That's going to be happening in other regions as well as countries build their own sovereign AI capabilities. That's the next growth area. And then, of course, where we go into robotics and physical AI, we're starting to see some traction there, as you can see from their earnings.
Yeah, also on the call, there were some concerns expressed around regulation, and particularly around this revenue sharing idea with the U.S. government. How do you see that evolving over the coming quarters?
That is a really bizarre deal where the government is taking a cut of the sales. I think part of it was related to being able to actually open the markets back to China as a concession. But I think we have to wait till all the chips have fallen in terms of how the U.S.-China trade deal looks like. There's so many concerns from national security. There's concerns on IP. There's concerns on trade balance. And the U.S. hasn't pulled all its cards out or played all its cards in the negotiation yet. But China definitely is intent on actually building a homegrown chip industry. And that's really the negative headwinds.
Well, let's talk about some of that share price reaction that we saw after hours. Nvidia was softer, but how rational does that move look to you in the context of the rather bullish longer-term story that you're putting together? Do you feel that this stock is overvalued, undervalued, or valued just right?
That is a constant conversation topic as to what the valuation for Nvidia should be. I would say that you're going to see a lot of people jump in tomorrow and buy into the dip. What is interesting is Nvidia is the least owned by institutional investors among the Mag 7. And it's a question to see what other institutional investors are willing to jump in. Do they believe in that story? And we'll be looking at trading volumes. But we're a little bit light. We're still kind of in summer in the U.S. And we'll eventually see what will happen. But I think you're going to see a rise tomorrow as people buy into the dip, because a lot of people are waiting to do that as share prices rose ahead of earnings.
Yeah, I just want to pick up on that narrative. I mean, it is the least owned among the Magnificent Seven of institutional investors. Why is that? Is it too expensive, or is there something else going on?
I think what happened is a lot of institutional investors continue to say it's too expensive, it's too expensive. And what they have is they've continued to miss out on the Nvidia boom. So they've been looking at what's in the second derivative and the third derivative where the AI boom will go. And they've been betting on energy in terms of small modular reactors and nuclear, the ability to do that. They've been betting on data centers, which are buying the chips. So they've been trying to take a safer approach. And yet every time they've continued to miss where the Nvidia shares were going. If you think about over the last 5 years, I mean, this stock has been up, at a ridiculous rate. I mean, you're looking at somewhere between 1,300% in 5 years, which is a huge number. And that seems very risky or volatile to the institutional investors.
Well, would you recommend a retail investor buy at these levels? As you say, it's not cheap.
I think you're going to see a lot of retail investors jump in tomorrow. If the dip continues for a little bit, you'll see people jump back in.
Yeah, so what happens at the open tomorrow? Do you think the market's just going to shrug this off, or could we see a little bit of a pullback?
I would think that you're going to see people jump back in. We'll see what the after-hours trading looks like. A lot of folks have taken the profits before the earnings. But I think what you're going to see is the folks that did not get a chance to jump into this want to take advantage for Blackwell is heading. Blackwell Ultra is heading. They're looking at the roadmap. They're seeing 601 million in robotic sales. They're seeing the stock buyback, and they're also realizing that this is still on a rocket ship to 5 trillion in market cap.
Yeah, let's talk a little bit about those robotic sales because that did come up. How much potential upside can you see there?
Well, the physical AI side is going to be important because we're going to see AI go from centralized AI moving to decentralized AI, which is at the edges. And that's robotics. That's the capability to actually do all the processing, not in a centralized cloud-based environment, but more in an environment where those individual robotics can make their own decisions and they come back. And, they had a federal autonomy day a few weeks earlier last week. And what they were able to show was that there's a 3-computer model, what they do from simulation in the Omniverse the ability to do training and the ability to run operations. That seems to be a very popular model. And in that room were a lot of folks that were from the federal government, and they were looking at it from anything from autonomous vessels to autonomous capabilities in terms of warfare, autonomous capabilities in terms of civilian use. And so you're going to see a huge demand there as it actually gets moved out to the market.
Well, we've already been hearing a lot about the Blackwell chip, and conversations already turning to Blackwell's successor, the Rubin, which is also going to require a substantial infrastructure build-out. Jensen Huang talking $3 to $4 trillion here. Aside from just buying Nvidia, what other opportunities do you see around that broader infrastructure and build-out story?
Yeah, there's a lot of opportunities to buy into the data center markets. You might buy into the hyperscalers that are doing that expansion. Companies like Oracle, companies like Google, Microsoft, and Amazon are leading that charge. You're also seeing stuff that's actually happening at the edges, and I think that's where you're seeing where energy is playing a big role. Looking at companies that actually have a small modular reactor capability or nuclear capacity, lots of hydro capabilities. You're seeing a lot of land being built there, and you're seeing a lot of data center build out along those lines. But we're also seeing the software side of the house pick up. You're looking at companies like Salesforce, companies like Adobe, ServiceNow, companies like IBM that are building out what they're on the AI side of the equation. And of course, there are other companies that are actually jumping in as we get into AI services. That's another area that's been picking up for the services side.
Well, you're sketching out quite a bullish narrative here, but contained in that answer, are there some potential risks as well? I mean, particularly around the energy side. Is there enough energy supply here to keep up with demand? And if not that, can you see any potential headwinds for this story?
You're definitely right. The headwinds are really around energy and really around China. What we're seeing are two things. There's this build out for advanced general intelligence and artificial general intelligence that's at the centralized level, and it's sucking up all the money at the moment. But what we're going to see is as we move to decentralized AI, you're going to see that move into other areas of the economy. And I think that's where the risk is. As there are other chips that are able to do that much more efficiently, and Nvidia in the future, looking at tensor processing units that are coming from Google, looking at other types of chips that are going to be put out at the edges, they're going to operate differently. And I think what you're going to see is a need for a smaller, much more compact, more efficient chip at the edges to be able to process less parameters, but be able to make decisions and automated decisions over time.
All right, Ray Wang, founder of Constellation Research. Thanks so much for joining us with your analysis today. And still to come, we're going to be talking markets with Fullerton Fund Management as concerns grow of a potential bubble, not just in tech, but also in Chinese equities. This is Bloomberg. Welcome back. You're watching Insight. Asia's technology stocks look set to extend their outperformance over US peers. This is amid easing tariff concerns and a weakening US dollar. Chip stocks in China have also climbed in recent days as authorities urged local tech firms to use homegrown chips. Investors, though, are growing increasingly wary over the onshore rally due to parallels with the country's 2015 stock market bubble, when a liquidity-driven advance pushed valuations far beyond economic economic fundamentals. Let's get a bit more on markets now with Robert St.Claire, Head of Investment Strategy at Fullerton Fund Management. Robert, thanks so much for joining us. I just want to start with that observation. You know, we do have Chinese tech stocks in particular performing pretty strongly this year, although having something of a pullback today. Do you feel that there is a risk that this rally is looking a bit overcooked?
Yes, good morning. It's a pleasure to speak with you. No, we do believe that this rally can avoid going into bubble territory because the fundamentals are quite sound. I think from the macro perspective, of course, policymakers are showing that they can achieve the GDP target, 5% plus growth. That's supportive for earnings growth expectations, which does continue to rise higher. And I think what the market is doing is it's pricing in those better earnings performance to come, because from the external environment perspective, China is also showing that it is defending its global market share, and that's very important in this new regime of greater protectionism from the US side. So collectively, we do see this being a fundamentals-driven rally and not into bubble territory.
How are you finding your way around this whole Nvidia H20 chip to China story? Because, you know, it's shifting sands really in terms of what the US is prepared to allow and now what China is prepared to allow its consumers to buy. How do you see this unfolding?
I mean, I think this is kind of the new real political world where we are seeing this industrial policy, and whether it's focused on IT and chips or what the US has done with Intel, all of these different factors, I guess, are highlighting the importance in this new environment of protecting your intellectual property. And of course, it's very important to defend the value add that you have from your products in foreign markets. So I think investors and companies are adapting to this in the sense that if you have a high value added product that's a key ingredient in the production process, and many of the IT outputs, especially chips, are, then consumers will pay that premium because, you know, it's a must-have piece of technology. And I think at the same time, companies, and China is kind of ahead of the game in that respect, they are looking to diversify their markets globally, and they are benefiting from stronger industrial demand, not just from Asia, but also from Europe.
Now, I know more broadly you're quite bullish on the whole AI story, although, you know, we were discussing just before the break, Nvidia forecasting slower sales, a slower pace of investment as well. Do you have a sense that, you know, if the AI story hasn't peaked, it's getting close to the peak?
I think what's very different about the AI story this time in the US is we just look at the fundamentals for the tech sector. Their earnings growth expectations have slowed. They've actually normalised back to around 15% per annum for the next 12 months. That's a fair assessment in this environment. But I guess what's most important is that tech sector returns relative to the market have returned back quite nicely to trend. So that outperformance can be sustained without going into bubbly territory. And I guess from the demand and supply element, what is very supportive is that US corporates are still investing a lot in new technologies and software. For Q2, real spending was 10% plus, so that's important. But then also on the demand side, of course, consumers are benefiting from the range of products that AI can shift into. The whole metaverse demand and all of these things are being met. So I think it's those dynamics of strong supply and demand side, as well as technicals for the sector, that suggest that this is an earnings-driven rally, and, you know, investors are attracted to that premium because the earnings potential is there.
This is something else we discussed a moment ago as well, but is there an infrastructure story to invest around also in terms of electricity and water? And I mean, at the same time, is there potentially a bad news story here for AI in terms of competing demand for scarce and expensive resources?
I think going forward, it's always going to be a balancing act, right, for firms in terms of, green-friendly investment, energy-efficient investment, and, of course, the greater demands that metaverse will bring. And I think that market pricing will be effective in that, but also, of course, policymakers' directions will be important. We all know about the green initiatives that are helping, at least with respect to energy conservation and such going forward. I think that the bigger overarching story that you highlighted in terms of this industry demand, it's something that we're seeing across all markets, whether it's Japan, whether it's Europe, or whether it's the US, and of course in Asia more broadly, and China, is the industrial sector is doing very well. And I think that is because it is meeting the AI demands, but also the green energy and new technology going forward. So kind of at the moment, I think these two things are working together in tandem and reinforcing the opportunities for investors.
In terms of the industry story, it might be a good moment to talk about India as well. Of course, the market going to be reopening there after that pretty hefty tariff hit from the US. How do you see that being resolved, and how bullish are you on India at the moment?
Yeah, so I mean, if we look at Asia, of course, India does have the most headwinds in the region. It is lagging its performance in terms of returns, but I think some of the positives looking forward is I think a lot of bad news has been priced into India if we think about the fundamentals versus the pessimism surrounding the tariff impacts. I think from the fundamental perspective, earnings growth for India has slowed a lot, but it's still around mid-single digits, and it is in line with the Asia regional average. I guess more importantly, investors for India are still paying above average valuations, which does suggest that they have a long-term confidence in India's fundamentals, and that does reflect the fact that, of course, inflation has come down in India. Yields are also lower. That can be supportive to domestic demand going forward. And I think a lot of the case with the tariffs, a lot of the devil, of course, is in the detail. So some of the sectors that are exempt, of course, are the higher value added products for India, the exact kinds of things that it wants to shift up the curve on. That is pharmaceuticals, as well as, of course, smartphones, because Apple is producing in India and that is going to be exempt. So there is a lot of, I think, perhaps overblown pessimism in terms of, the impacts on India. They do have a diversified export base, 20% share to Asia, 20% share to Europe, so they can adjust themselves over time. It will take time, but we do believe that earnings can continue to grind higher and returns should improve going forward.
Robert, just got a couple of minutes left, so I just want to get your thoughts on Fed policy, because, of course, we've got the PCE deflator coming out in 24 hours or so, a little bit less than that, Fed's preferred inflation gauge. What are you expecting to see here? Is the feed-through from tariffs going to be visible? Is it temporary? And what's the next move for the Fed?
Well, the impacts of tariff is certainly coming through. So the nowcast for PCE inflation now is 2.7%. The Fed expects that to be 3% for this year. It could overshoot that. We could see 3.5%. But I guess the key thing, and you hit the nail on the head, is that the Fed believes that it is a temporary inflation shock. Inflation will be back to 2.4% next year. And that's the macro consensus as well as the forward market pricing. Now, why should the impact of tariffs on inflation be temporary? Well, the key thing, of course, that is still helping a lot in the US is strong productivity growth. We have falling real unit production costs. That's giving significant cushion, and that's a key reason why inflation can correct back next year after the shock of these tariffs. And the other key point, I guess, is that inflation expectations have also come back, especially for the household sector. They were very pessimistic. They thought inflation was going to hit 6%. That has come back to 4%. So I think all of the groundwork is there for this to be a temporary inflation shock, and markets should be able to navigate through that.
All right, St.Claire of Fullerton Fund Management, thanks so much for joining us. Just want to take a quick look at how benchmarks are tracking at the moment. Seeing a little bit of weakness after those Nvidia numbers, perhaps. Well, I mean, everybody expects to be blown away by those, and we weren't. So just a bit of softness here. The Hang Seng off by about 0.8%. Of course, we're seeing Meituan shares dropping as well after that second quarter results miss. Alibaba and JD.com also moving lower. All right, we've got the yen there, still at 147.20. The Aussie now parked above 65 cents. But in a moment, we're going to talk about Indian markets reopening following yesterday's holiday. That was the same day the US hiked tariffs on some goods to 50%. Our expert panel joins us next as we count down to the start of trading. This is Bloomberg. Welcome back. You're watching Insight. In an interview with Bloomberg Television, White House trade advisor Peter Navarro cranked up pressure on India to halt its purchases of Russian oil. And he repeated accusations that New Delhi is funding the Kremlin's campaign in Ukraine and also casting the conflict as Modi's war. Now, this comes after a 50% levy on Indian goods came into effect on Wednesday.
Are we actually in talks with India right now? Is there a potential for a deal to change that number?
Look, it's real easy. India can get 25% off tomorrow if it stops buying Russian oil and helping to feed the war machine.
Not sending that signal?
They're not. And look, here's the thing. I'm puzzled, okay, because Modi's a great leader. These people this is a mature democracy with intelligent people running it. And they look us bald-faced in the eye on the tariff part and say, we don't have the highest tariffs in the world, when, in fact, they do. There's no dispute about that if you look at the numbers. And then they say, oh, we're not going to stop buying Russian oil. Now, what does that mean? I mean, we've talked about this, but it's worth talking to your viewers again. When India buys Russian oil at a discount, and then Indian refiners, in partnership in India with Russian refiners, make that and sell it at a premium to the rest of the world, right? Russia uses the money it gets to fund its war machine, kill more Ukrainians, and then the next thing that happens, of course, is Ukraine comes to us and Europe and says, give us some more money. So everybody in America loses because of what India is doing. The consumers and businesses and everything lose, and workers lose because India's high tariffs cost us jobs and factories and income and higher wages. And then the taxpayers lose because we got to fund Modi's war, okay? The road to peace runs at least partly right through New Delhi. I mean Modi's war.
Let me ask
because the road to peace runs in part through New Delhi. I mean, that's a lot of money.
It's a lot of money.
It's a lot of money.
But there are some who say that we're losing leverage with China by eliminating the next biggest economic alternative.
You know, I'm so tired of these national security strategists being too cute by half. The reality is you got to stop India and China from buying Russian oil. You do that tomorrow when the war's over. Okay? The war's over. If everybody, including Europe, this is like Europe's still buying Russia oil, which is crazy, okay? If people just stop buying Russia oil, then it's only a matter of time before Putin doesn't have the money to fund that war. So Modi's a big part of it. It's 1.5 million barrels of oil a day. That buys a lot of drones and bombs to kill Ukrainians. Okay, a lot. Okay, so what's troubling to me, Joe, is that the Indians are so arrogant about this. They say, "Oh, we don't have higher tariffs. Oh, it's our sovereignty. We can buy oil from anyone we want." India, you're the biggest democracy in the world. Okay. Act like one. Side with the democracies. You're getting in bed with the authoritarians.
All right, that is White House Senior Counselor for Trade and Manufacturing, Peter Navarro, speaking to our colleague Joe Matthew there. Let's take a look at how the Indian rupee is tracking. Just started trading a short time ago. It has been on a 5-day losing streak, and it is, of course, hovering around record lows as well. And then we see a little bit of strength coming in for the rupee, but that is, of course, relatively speaking. And this is, of course, about a day after those 50% tariffs came into effect. And we'll have the market open for you as well at about 12 minutes' time. We'll see how equities react to those tough new imposts. Well, India's exporters say that they're not going to be able to survive without government support after President Trump's 50% tariff on the country came into effect on Wednesday. For more, our India trade and economy reporter Shruti Srivastava joins us from New Delhi. So, Shruti, what are you hearing from India's exporters?
So definitely the 50% tariffs which kicked in from yesterday, they have sent a shockwave around the exporting community, and exporters are seriously concerned about their future exports to the US, especially the key labor-intensive sectors such as textiles, footwear, leather, gems and jewelry and marine. Exporters have already started seeing the impact of high tariffs. They're seeing that the orders are drying up. The US buyers are relocating their supplies, their orders to their Southeast Asian rivals. Now, let's keep in mind that 50% tariffs are among the highest in Asian economies, which India competes with. So definitely it's going to be a big impact. We have seen a lot of exporters saying that they have to lay off workers because of the 200,000 plus exporters in India, almost 80,000 depend on the US market for their exports. So 1/5 of India's total exports, they went to the US. So you can imagine the kind of impact exporters are already starting to see. Some of the exporters, they're also saying that they are ramping up their production in facilities which are in areas, in regions which have lower duties like Bangladesh and Cambodia, so that they can retain customers. They're offering deep discounts to their US buyers to retain them. And yet, some of the US buyers have already told them to hand over their product specifications to their competitors in Bangladesh and Vietnam, countries like Bangladesh and Vietnam. So we can see that definitely 50% tariff is something which is untenable, and it's not going to work for Indian exporters.
So if there's going to be stimulus, what might the government roll out, and would it be enough?
We have seen that the officials have been signaling at supporting the exporters which are impacted by the 50% tariffs. We wrote that there was a meeting, the top-level meeting by Prime Minister's office to see what kind of support can be given to the exporters. Exporters are seeking cheaper loans. They are seeking wage support. They are seeking tax benefits to somehow ride through this tariff storm from the US side. The officials have signaled that something is coming soon, especially for labor-intensive sectors, which would be hit hardest because of the high US tariffs. But the contours of such a stimulus is not yet clear, and the government is yet to announce it. So we'll have to wait for a couple of days to see what action the government takes on the stimulus. But would it be enough? That's hard to say, because for the most pressing concern for exporters right now is the cash flow, and that is one immediate support that they are seeking from the government to ensure that there is no liquidity problem for them.
All right, Bloomberg's Shruti Srivastava there. Thank you so much for joining us. Let's get a little bit more insight on Indian markets with our panel of guests. Chanchal Agarwal is Chief Investment and Strategy Officer at Credence Family Office, manages more than $2 billion in assets. Kevin Carter also joining us, founder and CIO of EMQQ Global, and that's an investment management and research firm focusing on the emerging and frontier markets tech sector. Thanks both for joining us today. Kevin, I just want to start with you. Ahead of this open, I'm just wondering what sort of market reaction you're expecting to see to this 50% tariff impost. How much is priced in? Because it's not like we didn't know it was coming.
Well, I mean, that's exactly right. I mean, this isn't news. The market's going to open, but the situation, I think that the reality, at least I think, that it's unlikely that the 50% tariff is going to be something that stays around for a long time. I mean, first of all, I think the Trump administration is focused very hard on trying to end the war in Ukraine, and I think it's one of the last levers to try to force some resolution to that conflict. And once that's resolved, Russia may, be back and be included, and it won't be a problem at all. So I'm not worried about it. Obviously, Indians are worried about it, but I think India is in a fine position, and this will pass.
All right, and just right on time, Kevin, we're seeing the pre-market starting in India. Not seeing a lot of change there in pre-market trade ahead of the open there. In fact, Nifty 50 futures up by about 0.25%. Chanchal, I want to bring you in with pretty much the same sort of question. I mean, do you anticipate we're going to see much of a reaction today, considering we saw this coming? But longer term, what is your outlook for Indian equities?
No, I think I'll echo what Kevin mentioned. This is something that market had already priced in, right? And until yesterday, everybody was hoping that this would be more of a bargain deal between the governments, and you could reach out to a more situation where you're able to manage this better. As it stands today, seems like a reality. A whole lot of it has been already priced in. Even if there is a shocker, I don't see it beyond 1% or 2%. In fact, I think the greatest thing for us to look at would be how's the consumption dwelling up, right? There is so much happening on the rural consumption side. I will be more keen to see what's happening on urban consumption. How are these NBFC faring? So I'm more concerned, and I'll have all my eyes on the domestic news. This news seems like it will have its own natural progressions and will falter down.
All right, Kevin, I want to come back to you with that point that you made a little bit earlier. You don't expect this 50% tariff to last, and certainly the experience with other trade negotiations around the world does suggest these things get ironed out. But which side do you see backing down first here, the US or India? Because both Presidents Trump and Modi put a premium on nationalism. Someone's going to have to back down here. Who's it going to be?
Well, I think that the resolution of the Ukraine situation will change the whole picture. Now, remember, India was buying oil from Russia when President Trump took office again, and through the early negotiations, India was still buying oil, and no one brought it up, right? So again, the timing of when this hammer came down as Donald Trump's trying to push this deal, I still think this is a poker play here by the president, trying to again push this Ukraine thing over, some kind of a line to stop the battling. But I don't expect it to stick around. I would be very, very surprised if 3 months from now there's 50% tariffs on India.
Well, at the same time, within India, perhaps equally big is this discussion around a consumption tax reduction. How's that informing your strategy at the moment?
Well, it certainly helps. I mean, look, we're focused on... Oh, I'm sorry. I thought you asked me.
Yes, Kevin, I've just asked you to continue, and I'll come back to Chanchal with the same question in a moment.
Okay, I'm sorry. What we're focused on is the new age tech sector, which is largely consumer driven. And so anything that helps the consumer, helps that middle class continue to expand or give them more, disposable income, anything that does that certainly helps what we do.
Chanchal, I just want to return to some of your observations as well. So we've outlined the environment fairly well here, but are there any specific sectors that you would be avoiding in this environment? Any suggestions you make to investors looking to rebalance or change their portfolio in the coming quarters?
Yeah, sure. I think amongst equities, I am very hopeful and excited about the way domestic consumption could really shape up, because this is one sector which was under tailwinds for a longer period of time, right? I like that. I liked domestic cyclicals, so you could see a sector rotation over there. On the bond side and on the duration side, I'm very hopeful and excited about the 7-year, 10-year spread curve that is coming up. So that is one space that I'm following and pretty hopeful over there. Even if there is a small risk repricing over there, there seems to be a good capital gain story over there. Third thing which is very exciting about India is the way whole commercial real estate cap rates have come up. I mean, it's at 8.5 at locations like Mumbai, Bangalore, etc. So I will be very excited to see how commercial REITs and REITs are coming into picture. So these are the three areas that I'll closely watch for.
On the bond side, do you anticipate there might be a role here for the RBI in the months ahead as well? I mean, inflation's coming under control, but as the full picture on this tariff story begins to unravel, do you think we could potentially see more easing, and would that affect any of your decisions around duration?
So actually interesting question over there. I think if the easing has to do with rate cuts, I strongly believe we are at the fag end of rate cuts. So you won't probably see a lot of rate cuts coming from the Reserve Banker, to my mind, but you could see systematic liquidity being pushed, right? I'm expecting some forex interventions given the whole FPI outflows that we have seen, more relaxation on banking, more relaxation on NBFCs, which in some sense deal with mid-corporate credits who are in some way exposed to the export tightness because of tariffs. So easing, to my mind, will be a whole lot on that front, and which is where I'll be very excited to, to narrow it down, I will be very excited to look at, say, somewhere between 5-6 year to 7-8 year curve. I'll be very excited to look at that and build positions over there.
Kevin, I just want to get back to you as we count down to the open. I mean, we've seen banks and IT firms in particular in India facing a little bit of earnings pressure. Do you have any concerns about profitability here?
Well, again, I'm focused on the new age tech sector, and the stage that India is in, especially with its new age tech or internet companies, you really don't want these companies focused on near-term profits. Of the 26 publicly traded India new age tech companies that we own, only 2 are not profitable currently. So as long as they're profitable, I don't think you want these companies focused on near-term earnings growth or meeting the quarter-to-quarter expectations of the street. I think what you want them focused on is the long-term greenfield growth opportunities that exist in almost every direction when it comes to the new age tech companies in India.
Kevin, we've just got the open here in India as we speak, and we're seeing a little bit of softness here, but perhaps not too much to spill any tea. We've got the Sensex off by about 0.25% there. The Nifty Bank Index, the worst performing sector right now, off 0.4%. But Kevin, I just want to pick up on what you cover. I mean, you have a flagship ETF that looks after e-commerce, internet activity as well. It's up 28% on year. But it's been a pretty wild ride for your investors. What's the longer-term outlook, though?
Well, the longer-term outlook really couldn't be better. I mean, in emerging markets, you have 6.5 billion new consumers. They're getting their first computers, which are pocket-sized supercomputers, smartphones. Those devices are getting better and more affordable every year. And they're bringing the internet to those new consumers. And this is the greatest story maybe on the planet right now, when we're talking about 6.5 billion people that have their first computer and their first internet access. And in India in particular, it's very early. When the first wave of the internet was the developed world, people like me here in San Francisco starting in the year 2000. And what happened? The FANG stocks took over our lives and our stock market, first on PCs, then on smartphones. The second big wave of the internet was the China wave, and we saw what happened there. Alibaba, Tencent. Now, Chinese equities haven't done great, but fundamentally they've had massive growth, and the internet companies have done the best. And now we're on the third wave, which are the other emerging markets beyond China. And within that group, India stands alone. It's the biggest. In fact, it's bigger than all the other emerging markets. If you leave out China, it's the youngest and has the best demographics. It has the fastest GDP growth, and that's driving consumption. And it's very early in that process. And so I think if I was an Indian investor, I would buy and hold the Indian new age tech companies across the board, as we do, or some of the leading ones that may do better than others.
Chanchal, I'd like to get back to you just as we watch the first few minutes of trade in India there coming back from the public holiday. Most of those major indexes off around about 0.5%, perhaps a little bit more as well. And I've got to give you some credit here. This was pretty much exactly as you predicted. But how long do you see this pullback lasting? Is it going to be a short-term thing, or could this become something more enduring?
So I think some challenging news over there. I would expect this to be a time correction, right? So from if I have to put some time duration for you over here, on a 3-6 months, I'm not expecting any surprise or major good news coming from India, largely in terms of the market flows. This could still stay up and down here and there, and 6 months down the line, I do think there is a very large buying opportunity. So if you are a tactical long-term investor who's looking at India from a longish perspective, all these pullbacks from market could be an interesting time to build positions, not only because of the consumption and domestic story, but you also have a lot of new age businesses which have started to list in India, right? And you and me can keep debating about the kind of valuations that we have, but look at it, there is still a very strong potential for these businesses to grow into larger numbers. So on a longer term period, I'm very excited. I'll be a buyer at all dips over here. Short term, I'm expecting this to be more of a time correction. So no exciting surprises over yet. Watchful on consumption, watchful on NBFCs.
And Chanchal, you mentioned some of these new companies that are appearing on the Indian scene. I mean, Kevin has been talking about those. They're core to a lot of what he does. Are you a buyer of these young, up-and-coming Indian tech stocks, or is some of the volatility that we've seen in that sector a little bit too much? I will be a selective buyer over here because I'm a little concerned of the market exuberance over there. I'm expecting that to slowly fade down, and that could be the right opportunity for us to get going on a couple of these names. If the question is, will I be a buyer on the IPO trades for these companies? Probably not. I would want to study their behavior and see how the growth numbers pans out. See, broadly, if the tariff news does stay, and if this is a reality, I'm expecting numbers till Q4 to be a little more concerning for all of us. At those times, I think markets will give us ample opportunities to jump in. All right. Kevin, I just want to ask one last question before we wrap up this conversation today. I know you've got a few favourite names in India. Can you just briefly tell us about those?
Well, my favorite name, I think, and the name that I talk about the most because it's such a great example of all of the great opportunity in India is Eternal. You're talking about a profitable company growing incredibly fast. And if you look at almost every vertical, whether it's food, online food and groceries, the per capita spending on that can grow 300 or 400%. And it will still be early in India. And as many viewers know, Eternal is not just one company; it's 3 different businesses. The food delivery business, obviously, Zomato, the original business, but they recently changed their name because they have 2 other businesses growing at 100%, both of which are very significant opportunities. The most exciting by far, I think, is Blinkit and Quick Commerce, which this is a consumer behavior changing business model, and it's in its earliest stages, and yep. There's going to be winners and losers and a lot of volatility, perhaps, but Blinkit seems to have a pretty good head start, and so that business. I think Eternal will be a 10-bagger.
We're out of time. I'll have to end you there. I'm sorry, but Chanchal Agarwal of Credence Family Office and Kevin Carter of EMQQ Global there. Thanks so much for joining us. We have plenty more ahead. This is Bloomberg.